Bank of Canada cut its benchmark interest rate by 50 basis points this week. That was the final rate cut announcement of the year, and it was a consecutive jumbo-sized cut. And it brings the bank's policy rate to 3.25%. Ultimately, we want to know what the decision means for fixed income and credit markets across Canada and a little bit of context globally, and also how might the Fed's next move impact the yield story, the story of divergence. Joining us now to get his reaction and to the latest Bank of Canada rate decision and also what it might mean overall for Canadian investors is portfolio manager Tella. Hi, Sri. Great to see you again.
Hi there. Sorry. Nice to see you too.
Oh, it's great. Glad we've got you there. And we'll invite everyone to send their questions in over the next little while. We're really digging into sort of the fixed income, the credit markets ultimately with you. I was fascinated by currency as well, but let's begin by just your thoughts on, it wasn't that bad. I mean, I was thinking that a great big huge cut might send markets the wrong message. How did you interpret the message?
Yeah, I mean, I think one, they messaged things very well by sort of indicating that they were going to be moving to a more gradual stance. But I think if you go back to going into the meeting, there were a number of people that were expecting a 25 basis point cut, a number of people expecting 50, and there was a camp of people that suggested they should cut 25, but they were likely going to cut 50. And so I think, at the end of the day, there was enough data points to justify a 50 basis point cut. And because it wouldn't catch the markets off guard, given that there were a lot of people expecting 50, I think the Bank of Canada took that opportunity to go ahead and come in with the 50 basis point cut.
Do you think, I mean, what could have been different for them to make a different decision? Because it not everyone expected it to be a 50 point move.
Yeah, I mean, so in terms of, the reasons they gave for the cut was obviously growth has come in weaker than they expected. The unemployment rate has ticked up. There's an expectation that growth could be hit by the government's new immigration policies going forward. So they're generally trying to get ahead of that. But on the flip side, you still have, even though unemployment has gone up, because there's more people looking for jobs. It's not because people are losing jobs. We've still had positive job growth. We still have sticky inflation in certain categories, especially even though shelter inflation has come down, it's still elevated. More recently, you did see an uptick. So there are a number of reasons that would have pointed towards a more gradual approach. But at the end of the day, it's more about where they're going to get to as opposed to whether they did 50 this meeting or 25 and 25. That's kind of what we need to focus on.
You've been saying that for some time. It's the end game, or ultimately where they land for a longer period of time. For investments and for investing, and if you're looking at coupons as an overall way of creating income for yourself, 3.25% is not so bad, really.
Yeah, and if you look into a diversified bond fund, you're really earning something more closer to 4%. And so, yeah, if we look at yield levels over the last 15 years, we're still at in the highest quartile in terms of yields. Things still look attractive, and the risk reward is still very positive. So, I think we're in this regime where we're going to be a little more range bound in yields, especially term yields. We might see the front end come down as we see more rate cuts come into play. But if you look at 5 and 10-year yields, they're really in a fair range right now. And so when you look at that, you should be over the time be earning the coupon, the yield on your portfolio.
Yeah, and just talking a little bit about term premium, because this is something that it almost feels like an ancient concept in some ways that we haven't really thought about for a long time. But it's ultimately what investors will demand for higher risk, and that comes with higher rates and so on. What do you think the term premium story is going on from here? We're bound to see those rise?
Yeah, I mean, I think if you look back over the last number of years or decade, there was really no term premium priced into bonds. And that was because we were in this regime of ultra low rates, given all the things that happened through the pandemic, et cetera. I do think we're starting to see the notion of term premium come back into the markets. And if you think about for example, the 10-year yield, if you think about a 1% real rate over time and a 2% inflation target, then that should get you sort of term rates in around the 3% area, or sorry, rates around 3% area. And then to own a 5 or a 10-year bond, you would expect some premium over that. I think what we're starting to see now is a lot of that start to come into the market, or at least people thinking about it, especially as governments are running bigger deficits. Potential for fiscal policy to be a little bit inflationary out in the longer term. Where it's having a bigger impact is in the US as opposed to in Canada. I think in Canada, we're still seeing rates kind of be the term premium really not be that significant. But in the US, especially with the new incoming administration and potentially inflationary policies, that's starting to price in a little bit more of a premium demand for longer term bonds.
It's really well. So let's talk about duration there, because duration's sort of been dead, actually, to be honest. Everyone's looking a bit shorter term. They have been looking shorter term. That story's changing a bit, but the belly, more interesting of the yield curve. Longer term, what is unattractive to many investors about that?
About duration, I mean,
Yeah.
I would say that right now the only risk to sort of being out the curve is that we're likely to continue to see a steepening of the yield curve. So whether that's as rates go down or rates go higher, I still think we're somewhat range bound. So it's hard to say whether it's going to be because of front end yields coming down or long rates going higher. But ultimately, we should continue to see, we've already seen a disinversion of the yield curve, more so in Canada. And in fact, I think in the US, we just got sort of the disinversion of the 2 stands curve. And so we should see that trend continue, especially as front end rates normalize and central banks get to sort of their targets. And with term rates being fair to slightly rich, if you're thinking about longer term inflation, that's where the risk lies. But from an outright sort of exposure to rates, we still think that rates are relatively attractive, given that we're at cheaper levels compared to recent history.
Yeah, really interesting. When we spoke a few days ago, just sort of preparing for this conversation, it was a big story of policy divergence, which has been the story actually for much of this year. But it seems to be coming into a bit of a stark relief as we go into the end of this year. And there are just so many central banks around the world also having their rate decisions right now. Canada's in the midst of that, and the Fed is next week. Speak a bit to the fact that the Fed just, it appears, does not need to cut rates because they are in a pretty good position. The rest of the world is in various different states. Just tell us about that divergence story. Where do you think it's going from here?
Yeah, I mean, if you'd asked me 6 months ago, I probably would have said, so even if you think about Canada and the US, we were getting close to the limits of sort of that divergence. And when you look at it on a historical basis right now, it's not out of the norm where we are right now, but we are getting closer to the extreme. I do think that now that can persist a little bit longer, and you could see it sort of increase even in the short term, because we are sort of in a position where the Canadian growth has slowed down, and we are likely need to get to a more neutral stance on policy. Whereas in the US, you've had a number of factors that are proving the economy to be more resilient. You've had even stronger a bigger fiscal response. You're likely to have even more of that as we get into next year in the new administration. The labor markets have been extremely resilient. And then financial markets have made financial conditions extremely easy. And so I think all of those factors kind of lean towards the Fed remaining a little more restrictive. There's less of a risk of an undershoot of inflation in the US as it might be in Canada right now. And so the Fed's going to err on that side of being a little more cautious as it normalizes policy.
Tiff Macklin, went through all the pieces of the economy that he's looking at, the numbers, certainly the unemployment rate, which shot up a bit in the most recent report for November. There's a wage story in there as well. There didn't seem to be great concern there, but obviously noted, and it must have gone into the decision. What sort of weighting did you gather the unemployment rate made for this rate cut decision?
Yeah, so I think when you break down the numbers on unemployment, you have to think about what's causing that unemployment, right? And Tiff Macklem made that comment in the press conference. Right now the unemployment rate's rising because more people are actually looking for work, and that's especially due to younger workers and temporary foreign workers or temporary residents that was due to the immigration. So you've actually seen the number of people, the population growth has been off the charts, obviously, and that's part of the reason why there's more people looking for work. What he pointed out, and which is absolutely true, is people are not losing their jobs, right? So we're not seeing layoffs. In fact, you still have positive job growth, and that's kept consumer spending somewhat resilient. And so I think that there is obviously they're watching the fact that the unemployment rate rose. And they did point to the fact that that does create more slack in the economy, which warrants lower rates. But they're not concerned about it from a recession standpoint because people are still employed and not losing jobs, and therefore they don't necessarily need to be as aggressive. And I think that's why they signaled that things will be much more gradual going forward in terms of their monetary policy.
There are other pieces of the economic story to get to, but I wonder if we can just get into sort of what it means ultimately for allocation, taking a look at some of the positioning that either changes with this decision or gets accelerated. I'm just sort of curious what still looks attractive. Credit has been a really interesting story because it seems to be fine even with things reasonably tight. And we'll speak to corporate after.
Yeah, so there's a couple of things. From an outright rate standpoint, I've already sort of mentioned how, overall rates look attractive. There are a lot of moving parts with regards to the Fed and US inflation and even in Canada. And so from a duration standpoint, we're trying to stay relatively neutral to our benchmarks, but we still think that, fixed income generally looks attractive. When it comes to sectors, yeah, you're absolutely right. Credit spreads look very rich. In fact, we're at the tightest percentile, or the tightest the tightest decile for corporate spreads in Canada and the US. From if you look at the last 15 years. But that being said, because yields are so attractive and money's coming into fixed income, that's going to continue to result in demand for fixed income and corporate credit. And corporate earnings and leverage are actually in decent shape. So that still means that there is a spot for corporates to do well.
It's interesting what you mentioned about sort of almost the comparative story and what still means things can be healthy with credit spreads a bit tighter than we've been used to over the last decade or so. How far are you going back? Are you going back sort of pre-GFC to make some comparisons of what seems reasonable?
Yeah, that's a great question because that was one point I definitely wanted to add to that. If you think about it, generally, everyone's focused on post-GFC. That's all the references you hear are, since the global financial crisis, this is where things have been. We're at rich levels or cheap yields or so on. Interestingly, if you go back before the GFC, and there's a couple of periods, and there's a period in the 90s as well as in 2004, when you look at where yields were similar to where we are today, spreads were actually tighter. And in some cases significantly tighter. So now people will point out, and I completely agree with this, we were in a different market environment back then. There was a lot more leverage in the system, hedge funds, et cetera. And so that fueled sort of a real demand for risky assets and overinflated valuations. But if you just look at where yield levels are and go back to periods where we were at these types of levels, spreads were actually tighter. So that does tell you there is scope for things to go tighter. I don't think they necessarily will, but it does point to the fact that there's no real catalyst for things to widen, unless we get some exogenous shock. And that means that corporate credit, regardless of rich valuations, is going to be helpful because it gives you incremental yield over government bonds.
Has the high yield market done everything it's going to do for you now? Is it still very attractive going into the future? Again, do sort of recent rate decisions, policy decisions change the high yield story at all?
Yeah, no, it's a good question. I think you can make the same argument. High yield spreads look even more rich, right? If you think about it relative to investment grade credit, the sort of spread between investment grade and high yield is at an extreme as well. But that being said, when you look at the shorter duration nature of high yield bonds, and the fact that you are still earning about 270 basis points more than government bonds, and that extra yield gives you a lot of protection. And leverage is still well below. I'm sorry, default rates are well below where things have been expected. I think the trailing default rate has been about 1.5% roughly. There were forecasts for it to go as high as 3 to 4%. The longer term average is higher. So when you look at it from the sort of the fundamentals of the market, it still has a role. I would say you probably don't want to over-index to it, but at the same time, it's going to give you a lot of yield and gives you a lot of protection. So it does still play a role.
Take us to the government story, taking a look at the Canadian government bonds. Probably the issuance story would be one to ask, as well as our Canadian dollar gets a little lower. But speak broadly, probably at the federal level, and then we can also go to the provincial. But what do you like there?
In terms of government bonds, I think that there are concerns about deficit targets, and that the federal government is already going to move away from its fiscal anchors. I think in the long run, though, the Canadian government relative to other governments in other countries is still in pretty good shape. It'll be interesting to see what policies get put into place. We're obviously heading into an election year. And
that's what Tiff Macklin said too. He's like, we'll wait and see.
Right. And so it's really hard to say, but I do think there's a shortage of government bonds, especially out the curve based on relative to investor demand. And so, Canadian rates could stay lower than they otherwise should be as a result of that. The US is where it becomes maybe more of a concern because there's much more aggressive fiscal spending, much more issuance. And that's part of the reason why you're likely to see the US term premium and the US curve steepen out a little bit as well.
Really interesting. If you go to the provincial level, at one point you'd like this a lot. Again, does the rate change mean anything?
I don't think the rate change necessarily impacts things, but I think that provincial bonds on a risk reward basis look relatively attractive. We've seen some fiscal updates. They've been mixed over the last couple of months, but generally we've seen a little bit of weakness in provincial finances, but they're generally in good shape. Plus, most of the provinces are well ahead of their funding needs. In fact, they're either very close to being done for their fiscal year, which ends in March. And in some cases, some provinces are pre-funding, so they can kind of be much more opportunistic. The other thing is if you look at high quality corporate spreads, like a utility like Hydro One relative to the province of Ontario, they're at some of the tightest levels. And so, in fact, the Hydro One trades very close to, for example, the city of Toronto, and so if you think about those spread differentials are at very tight ranges. And when you think about owning a government entity versus a corporate, you would normally favor the government entities at those kinds of spreads. And so even though all spreads are tight, they're a much more defensive spot to be, and you're not really giving up that much yield relative to high quality corporates.
Is there a level of, again, in terms of positioning right now, of wanting to keep sort of some dry powder? This is a dry powder question, but again, we can tie it to the rate story, but it's probably a much longer term question for you. Will there be better times to enter certain different areas of the Canadian fixed income market and credit markets?
Yeah, and that's kind of how we're viewing the world right now. We have, even though we think we're constructive on corporates and what they'll add to the portfolio, we're still at the lower end of our historical exposures to corporates. We still have an overweight exposure, but we're not as high as we normally otherwise would be if spreads were much more attractive. What we're focused more on is moving away from having that exposure or overweight to just broad market exposure to more targeted idiosyncratic risk, finding the best companies, the best names to own, the best bonds. And that's where we really rely on our research team and our trading teams to identify sort of the specific opportunities as opposed to just having blanket broad market exposure.
For sure. And this is where the very active nature comes into it. But would you typify what you're doing right now as a little bit of a barbell strategy, or flesh that out for us a little bit?
Yeah. So the other thing, given where valuations are, and as I mentioned, the benefit of high yield in the shorter duration, we're doing the same thing in investment grade corporates. Most of our corporate exposure is in short to intermediate corporate bonds, where you have a lot more protection against any volatility in spreads. And then we're taking our government exposure and provincial exposure out the curve, because that's where we want to be a little bit more defensive. And so we tend to have, a lot of our corporate exposure and securitized product in the short end, intermediate, and longer dated provincial bonds. And we actually have an underweight to long corporates, just given how, as I mentioned, how tight high quality long corporates are relative to provincial bonds.
How much borrowing is going to go on from the AI story? We hear a lot about investments from big companies. Other sized companies are also making investments. Is this an area of interest for you to sort of the build out infrastructure story of the AI transition?
Yeah, I think I think AI generally, if I think about it from a portfolio or our standpoint in fixed income, it's probably more of an equity and growth story aspect as to who's sort of using it and benefiting from it, who's involved in the infrastructure. It's obviously going to be involved in sort of CapEx and investment in terms of build outs. I will say, though, generally a lot of the companies that are in that space that are involved with the infrastructure and build out, they're not necessarily big bond issuers. And so, because if you think about the tech industry in general is not a heavy weighting in the fixed income markets, because a lot of the larger companies that do it are flush with cash and so on. And so you don't see a lot of heavy issuance in those sectors. What I think you'll see is with the corporates we might invest in, they will earmark money towards investing in AI and thinking about how they can use AI to improve. But at this point in time, it's not a significant enough amount of their overall investment spend or CapEx spend that it's going to move the needle in terms of how it impacts us looking at their corporate health.
Right, that's super interesting just to sort of see that it might be more of an equity story at this stage. It might change. But so a question coming in addressing some of the things that you addressed at the beginning, but I think a lot of people just wanting to hear the voice of reason perhaps after a 50 basis point cut. So historically 50 basis point cuts are associated with economic downturns. With back-to-back cuts, should investors be concerned? Sure.
Yeah, I mean, I think you have to it has to be on your radar that there is a risk that things are slowing down. But I think the real element, and I alluded to at the beginning, is that the Bank of Canada wants to get back to a more neutral rate, because if you think about where inflation was and where we've gotten to, they don't need to be restrictive anymore. They are seeing signs of a slowdown, but they need to get back to sort of that neutral range relatively quickly. And I think they could have done 25, they could have done 50, but I think at the end of the day, they did 50 because the market was going to let them without panicking. And so, and I think that's also the reason why they commented that they're going to be much more gradual going forward, kind of indicating that they feel we're in a better place now, and it's going to be more data dependent. So, I wouldn't say there is a zero risk of entering a downturn. But we've still seen signs of positive growth. The US has been resilient. There's a lot of uncertainty around with tariffs and so on. We'll see. It's really hard to sort of say how that's going to play out. But I would put the base case right now as just a slower growth environment as opposed to a downturn.
That said, and the tariff discussion it's going to be happening, is ongoing. But being right next, and it's a global story too. It's not just coming at Canada, obviously, but does Canada fare better because we are physically right next to an economy that's doing well, that we trade with, and there might be some bumps there, but is it your base case that we get dragged higher with the US economy, basically?
Yeah, I mean, I think ultimately, yes. I think tariffs, if they get implemented, for example, would have an impact on Canadian growth slowing down. It also, the uncertainty alone impacts investment. And so that alone will slow things down even ahead of tariffs getting implemented. But that being said, I think the key thing to think about is, yes, if the economy in the US is doing well, ultimately we should benefit. There will be a negative impact initially. But the risk, and what some people are pointing out, is that tariffs being implemented, they may not be great for US growth, right? So ultimately, if it makes things more expensive in the US, and there's other aspects that cause things to slow down in the US, then that could theoretically have a negative impact on Canada as well. So, but I think there will be a middle ground where there are sort of reason will come into play, and where, there's sort of threats of very high tariffs now. Maybe we settle in for something a little less impactful, or it's really what people think it is just a negotiating tool to get other concessions out of Canada and Mexico, and maybe not even really implement any significant tariffs down the road. So, but ultimately, our economies are intertwined. So I think that the US will be a big driver of how things play out in Canada.
What do we do with the loonie? It didn't rocket to the bottom after this announcement on Wednesday, which it might have. I mean, this was sort of again, how we started. It could have plummeted. It didn't. We've seen some movement over the last sort of 48 hours, but currencies around the world, what say you for 2025? Is this a big piece of the story next year?
Yeah, I mean, I think that it really points to the strength of the US dollar, because as you mentioned, it's currencies around the world. The US economy has proven more resilient. The Fed's been much slower in terms of cutting rates relative to a lot of other countries. And so that's going to, generally lead to a stronger US dollar, and that's impacting all global currencies. I think to the extent that things have moved now, I don't think it's obviously going to be on central bank radars, but I don't think it's been a big enough impact as of yet to really lead to concern. I think for Canada specifically, you'd need to see the Canadian dollar get hit even harder before the central bank started to do things on the margin to improve it. This Bank of Canada has pointed out that the transmission or the linkages between the currency and the economy have weakened over time. And so that they're not as concerned about these sort of near-term moves. And I think people will also point out the Canadian dollar has actually fared well relative to other global currencies. It's really more of a US dollar story. So I think it will persist, and because the US is in a better place. But I'm not a currency expert, so I'll leave the sort of forecast to them. But I think we're settling probably in kind of more of a range here, slightly weaker levels for the Canadian dollar and for global currencies relative to the US in the near term.
What would you say to those investors who are investing in some of your funds now, ultimately might look to them for the year to come or throughout the end of this year? Just speak to sort of the case for taking a look at why now for bonds.
Yeah, I mean, I think I have the similar argument sort of every time the question comes up, but we pointed out how yields are generally attractive on a long-term basis. When you look at sort of the backdrop of the economy and how we're relatively in a range in terms of both growth, inflation, yields, I think the expectation should be that you would be over time to earn the yield on a bond portfolio. And so, you are getting paid to hold bonds now. They are a diversifier in the portfolio, and they provide that cushion against volatility. And and risk. And so I think when you look at it in a broader portfolio context, there is a good role for bonds to play. And when you think about valuations across asset classes, everything looks expensive right now. And so when you actually have an asset class that you think could be fairly priced, that actually makes it relatively attractive versus other sectors.
100%. It's great to catch up with you. Thank you so much for your time, Sri, and wishing you all the best for the holiday season.
Yeah, thank you. Same to you and everyone else out there. Happy holidays.